Hi everyone, I'm Lynette Zhang, Chief Market Analyst here at ITM Trading since 2002. Since 1964, I've been a collector and a banker and a stockbroker, so it's easy to see that I've been groomed for this moment in time. And frankly, I'm on a mission. My mission is to convert financial noise into understandable language. My goal is really to help people understand what they are legally agreeing to and those hidden costs and fees that they're actually paying all along the way. Now, my opinions are based upon data and facts, and my preference is to go directly to the source. Now, I listen to what they say, but for the truth, I watch what they do. And these are the things that I share with you on these webinars. My hope is that when you see this evidence, you believe what you're seeing, and if it's appropriate, that you move forward and act on it. Now, some of you may already have your positions built, so the webinar today is going to solidify for you why you've done what you've done. But for those out there that have not yet built their positions, I urge you to get it done. I mean, even the central bankers, the guys that are driving this financial bus, are warning about the fragility and the lack of liquidity in the system. Now, actually, before we go much further, I would like to take a second here and thank those of you that have been supporting this series right along. Last week, many of you probably know that I sent out an oops email, and you could probably see a little bit of frustration. But the response that I got from you guys was really amazing to me. And, you know, it was really also inspiring that, yes, I am going in the right direction because I really am here to be of service to you. So I would like to thank you for that. So now I'll do the little disclaimer before we begin. ITM Trading recommends that 5 to 20% of your overall investment portfolio be placed in precious metals. However, the decision as to how much to allocate is strictly up to you and or your financial advisor. You definitely need to be aware that my opinions may or may not reflect the opinions of ITM Trading. So grab a pad and pen, type in any questions as they come up. I will address all of them at the end of this presentation. So first, I would like to welcome you to a peek beneath the skin of the markets, which is all about enabling educated choices. Today, I'm going to present my case for why you need physical gold. There are three key areas, though I'm only going to hit on three, but number one, gold money prevents inflation. Number two, it runs no counterparty risk. And number three, it is severely undervalued. In my opinion, this is likely why the ultra-wealthy, the governments, and the central bankers have been accumulating gold at a very, very rapid rate since the beginning of the crisis. So first, we're going to start with the inflation piece. And what you're looking at here is you can see quite clearly that during periods of war, we would go off of the gold standard for a minute. Inflation would heat up. They would fund the wars. When the war was over, the currency was no good. We'd go back to a gold standard. So over time, being on a gold standard held your purchasing power intact. But obviously, we all know in 1913, we went on to, and the intention was to do a purely fiat system, and there's the inflation since then. So kind of keep this in mind as we move forward. Oops, sorry about that. So, this is acting a little funny, Carl. Now, one of the reasons why gold holds your purchasing power is because it is rare. All the gold that's ever been mined fits into 2 Olympic-sized swimming pools. Plus, it is indestructible. So we can account for pretty much all of the gold that has ever been mined. In addition, it takes 20 years from discovery to development to produce a working mine. And you can see on this discovery chart that peak discovery of gold was back in 1995. So, and it's been declining ever since. So there simply is not really all that much gold left. In addition, gold is all intrinsic value. And I say that because it is used throughout the entire global economy, particularly in the monetary system where you see those official holdings. Silver as well, physical as well. I mean, you cannot do any of these things with paper gold or digital silver. Okay, now this is a current table from the World Gold Council on supply and demand. Now, one thing that should really jump out at you is the extreme surge in the first quarter of 2016 in investment demand compared to same time last year. And we do know that demand has been increasing every year since 2008, and yet the price has gone down. So that's clearly an indication of manipulation. But so now we see that these are many reasons why gold holds purchasing power, and this is how you benefit from it. Because money is really just a tool to hold any excess labor that you generate today for use in the future with the same level of purchasing power. The finite amount of gold puts restrictions around government's ability to create that inflation. Because if you noticed it, you would go in and convert this government bill into government gold, putting further restrictions around what they could do. Now, they used the crisis, the stock market crash in 29 and the subsequent depression afterwards, to confiscate the gold and take away the only tool that the public really had to protect themselves from government money inflation. And you certainly saw what that looked like in that first inflation chart. But some people have said to me, well, I just don't believe that. How could they get away with it? Well, let me show you. It's actually pretty simple. And truthfully, perception management at its finest. This is John Maynard Keynes, the father of Keynesian economics and the foundation of our monetary system. And I'm just going to read this for you. Because what they knew is a sentiment of trust in the legal money of the state is so deeply implanted in the citizens of all countries that they cannot but believe that someday this money must recover a part at least of its former value. Well, they knew that that's what people thought. Now let's look at the results of that. And here's my very favorite chart, as you guys, many of you will probably know. This is the chart on the purchasing power from the Federal Reserve. And what it reflects is a compounding erosion of that purchasing power since the day the central banks took control of our money supply. So it's inflation, which is the fiat money disease. They can get away with it because we've been trained to think in nominal terms, and over time we've learned to accept the real value decline compounding over time. So even though down here we can see that nominally, okay, if you had $1 in 1913 and you still had that dollar today, nominally you have the same amount. But purchasing power, you can only purchase 96% less than you did back in 1913. Unless you think that was just flattening out, this is that same chart between 2000 and recently, just recently I pulled it. And you can see that that compounding erosion continues with a vengeance. Really, it doesn't let up. Now, this is only possible in a fiat money system. And we are seeing this march toward zero, just like more than 4,800 currencies before that. And this is how it impacts you, via inflation. Now, if you had a $20 bill 20 years ago and you still have that $20 bill today, it's still a $20 bill. That's the nominal value. But the real value is what you can convert it into. In this case, a basket of groceries, where it either takes more of these to buy the same thing, or you get less with the same amount of money. So this is how it's working in terms of loaves of bread. Okay, back in 1912, you could buy 11 loaves of bread with a 1/20 of an ounce of gold or a dollar bill. Today, you're lucky to get a third of a loaf of bread with that dollar bill. But that 1/20 of an ounce of gold, you get 16 loaves of bread. So what I'm telling you and what I'm showing you is that gold money cannot be inflated away. It prevents the government's and the central bank's ability to create inflation for you. So now let's take a look at some of the counterparty risk that is inherent in fiat and government fiat money. Number one, we've talked a lot in the different webinars about financial fiat money, financial products, but legal tender laws are a huge risk in fiat money, because if the government declares, well, this is legal, they can also turn around and say it is no longer legal, like they did with this gold certificate back in 1933. But also, other governments could still convert U.S. dollars into U.S. gold through this gold certificate, which was legal until 1971. Now, these are just a few examples. There's actually more than 4,800 currencies that are no longer legal and used as a tool of barter. But you might actually recognize some of these larger bills that used to be in circulation and were pulled from circulation in '69. In my opinion, the reason why they pulled these from circulation was in anticipation of going fully off the gold standard in '71. And they didn't really, okay, again, my opinion, the reason why they pulled them from circulation was because they did not want the citizens, the individual citizens, to have the ability to hold a lot of wealth in a small package. And I would like to also point out that these bills are still legal tender, because if they had declared these illegal, they would have had to have declared the entire dollar system Federal Reserve notes illegal. And they weren't really prepared to do that. And we're seeing something similar happening today in Europe. These currencies were all legal in Europe until 2002. Then they went away and you had the euro dollar. Now this is the largest euro dollar in circulation, but they stopped printing those in May. So my guess is, similar to what happened to our larger bills, that they will simply, once they go into the banking system, they won't be brought back out into the broader economy. So legal tender laws can be changed, and that is absolutely a counterparty risk that fiat money runs. But the next counterparty risk that I want to talk about is hyperinflation, because in this system, money is created from debt. So when the debt load becomes unpayable, governments revalue the currency. They inflate all the purchasing power away, so these debts are repaid in dollars in this country that have no value. I'm going to use Zimbabwe as an example because I have 3 beautiful iterations of the currency as it went through hyperinflation. And typically, on average, that's how many times they're going to do it, because it seems to take that long. But this is from 2002. So when hyperinflation kicked into gear in Zimbabwe, a loaf of bread went to $85,000. And the government response? Well, they just lopped off 3 zeros. They didn't change anything. Did it work? No. Here's your next iteration of the currency, and you'll notice the smallest bill is a 5. But this was only good until July 31st of 2007. So that first one was 2006. This was good till 2007. Then beyond that, we have the next iteration, and this was good for only 11 months till June of 2008, and the smallest bill was $200,000. Now let's see, that loaf of bread that was 85,000 and then lopped off those zeros, where was that? That's how much it took to buy a loaf of bread in the hyperinflation. So this is definitely a counterparty risk that fiat money runs, because the government and the central bankers, up to a degree, can control the valuation in here. But how did gold behave during that period of time? Well, there you go. It exploded upward. But really, that was just in terms of Zimbabwe dollars, which have no value. You could barely convert them into a loaf of bread. So the counterparty risk that is prevented by physical gold outside of the system is that it holds your purchasing power intact as the fiat money goes away. This is one of the reasons why I say it is the single safest thing that you can possibly do, because the governments and the central banks are talking about a reset. The debt levels globally are huge and they're weighing down on economic growth. So absolutely, physical gold out of the system is the ultimate hedge. But that's not the only time we see this pattern. I mean, there's Russia, this is the Ukraine, and this is Venezuela right now. Now here's a question. When do you think the average Venezuelan should have bought their gold? Back when it was what, 169 bolivars for an ounce? Or up here at 1.5 million bolivars? The average citizen could have probably afforded some over here. Here, they can't get it, period. I think that we're somewhere in this country, somewhere in this vicinity. And yes, maybe you have to wait for it to express itself to full fundamental value. And I say hallelujah to that, because this is not really something that we want to happen. It is something that I believe is inevitable, and it's happened every other time. This is how gold has behaved relative to the dollar, bonds, and stocks in the U.S. since the start of this current trend cycle, so 99. So I'm going to ask you, of these four instruments, and this is the manipulated spot price even, which one of these has performed the best? Which one of these has held your purchasing power and your wealth intact? I mean, the pattern should be pretty clear. Can you see it? So these are known threats. I mean, it's happened throughout history. The legal tender laws have been changed, and hyperinflation, I mean, it's happened in every fiat currency. But the threat that I want to talk about now, the counterparty risk that I want to talk about now, is a new one that we haven't really experienced before, and most of us are really pretty clueless as to even how to protect yourself from it. And what I'm talking about is cyber theft. This is really a growing problem. PricewaterhouseCoopers reports in its Global State of Information Security Survey 2015 that the number of detected information security breaches has risen, listen to this, 66% per year since 2009. And that means that your accounts may well have been hacked, but you don't even know about it. Why? Because they're not disclosed. Because companies and banks want you to feel safe and secure using their system. They want you to leave your wealth in that system. And if you knew that they had been hacked, you might make a different choice. As example, did you know that banks, oops, I went a little too fast. Oh, sorry about that, you guys. Okay, did you know that banks had been hacked? 100 banks got hacked back in 2014 and 15. Lost $90 million. Now, there's been a lot of banking consolidation. So do you think it's possible that your bank might have been involved in one of these hacking? Do you think it's possible that your account might have been impacted in it and somehow you just don't know? Now I want to look at the statistics. I went a little too fast the other time. But in these statistics, what you see is that 22% of the times when the bank was hacked, they actually, this is a little bit too small for me to read, bear with me here, okay? So 22% of the time they were able to hold on to the funds. They couldn't pull them, the hackers couldn't get them out. But out of that, 10% of the time they were able to pull the funds back in. So that means that 68% of the time those funds were unrecoverable. Okay, can you see that? Now if you add up the 68, the 10%, and the 22, there's your 100%. So out of that 68%, 37% were not declared non-recoverable. Now, here's the thing. The banks reimbursed accounts as long as they examined everything and determined that it would cost them more to disclose to you that your account was hacked than just to reimburse it so that you couldn't see that there was a problem. But for businesses, they have fewer options than you do, so 60% of them lost money during that hack. I want you to really think about this because this is clearly a growing problem. And you would expect the banking system and the financial system to have the highest level of security. But even the highest level of bankers are not immune. So this year, this is SWIFT. This is the world's largest money transfer system between banks. And so far this year, there have been 4 central banks that have been hacked. So even where we consider to be the highest level of security, this is from the Wall Street Journal, that they provided startling evidence of the vulnerability of parts of the financial system that everybody thought were highly secure. So ask yourself this question. Do you really think that can't happen to you? Do you really think that? Because I'm pretty sure that's exactly what this woman thought. She can bang on those bank doors all she wants. What can you do when the computer says no? What can you do? Because remember Keynes' quote, they are absolutely counting on your steadfast belief. This is driving me nuts. Sorry about this, guys. But Keynes, as Keynes' quote said, they are absolutely counting on your steadfast belief in the fiat money system. So I've shown you how your wealth held in the system is vulnerable to counterparty risk. Now I'm going to show you why I say that gold and silver are severely undervalued. And it boils down to demand and supply, because we do know that demand has been growing at great lengths since the crisis hit in 2008. And yet, if you look at the Wall Street spot price of gold, that's been declining. And we can see from this chart and others that there has been a deficit in physical gold. And let me tell you, when gold goes into the coffers of the central banks and the ultra-wealthy, it doesn't come back on the market again. So there clearly is something that they know that you don't. So this is one reason why I say that gold is severely undervalued. Let me show you other reasons why I say that. Now this is the debt limit versus spot gold. Okay, interesting to note, I'm so sorry, this thing is giving me a very hard time today. Interesting to note that once the global central bankers came out and said, we will do whatever it takes, open-ended money printing, that's when they started really hammering the spot price of gold hard. And of course we know that the reason why they do that is because a rising gold price, and it is an indication of a failing currency. Now this is the Fed balance sheet, and it shows you the hyperinflation of the money printing that they injected into the banking system. Interestingly enough, when the crisis became apparent to everybody, they whacked gold about 35% at the same time that they did their first round of hyperinflating money printing. And then once they made that commitment, open-ended money printing, they whacked it again and a whole lot bigger. So you can't do this in the physical market. In the physical market, that's going deeply hidden and it's not coming back in the market. There is a limited amount of physical gold and silver, but there is an unlimited amount of Wall Street gold and silver, and it's easily manipulated, as I've shown you in other webinars. Oops. So what we're looking at here, I don't know if any of you had read Jim Rickards' latest book. I'm going to read a quote from that book because it's what we have facing us. And he says, "It's possible to devalue every currency in the world against gold at the same time because gold is money, but it's a different kind of money. It's not central bank money. Gold is the exception to the currency wars. Gold is the one form of money that every form of money can devalue against simultaneously without fighting currency wars. Gold does not fight back in currency wars. That means a much higher dollar price for gold." So what he's really referring to, the range that he puts in gold, is its fundamental value right now somewhere between $10,000 and $50,000. That is at this moment if they were to do the reset right now. And that's because the range is so broad because we really don't know what the cover ratio is going to be. But the more debt they grow, the higher these numbers go, and even if it was at the lowest level, the $10,000 level, which by the way comes very close to my calculations as well, I absolutely agree with him, you're still looking at gold somewhere around 1,200 bucks. It's a bargain. It is severely undervalued. It's on sale. So if you've built your position, great. If you haven't built your position, get it while you can, while it's available and while it's on sale. So really, I've shown you how gold eliminates the ability for the central banks and the governments to generate inflation on your wealth. I've also shown you that it runs no counterparty risk particularly when it comes to that hyperinflation, the legal tender laws, as well as the cyber theft. And there are many other areas. I'm just kind of picking and choosing so we can get through this pretty quickly. And beyond that, this is why it's the foundation of the dynastic wealth stool. Because these are the kinds of assets that can live through wars and regime changes and currency resets. Gold money, as the most important leg, supports all of these others and enables you to accumulate these others when they are dirt cheap. So now I'm going to show you the opportunities that present. Okay? For one thing, when something is overvalued, you probably don't want to hold it. We know that dollars are overvalued because every time a central banker opens their mouth, they say we need more inflation. And considering the fact that they are printing lots of money and zero interest rates and all sorts of things to generate that inflation, this be going down. So at this point, you can still convert government money into physical gold that will put you in a position to take advantage of the opportunities that typically present during currency resets. And really what ends up happening is that gold being undervalued moves up to its fundamental value. And the other assets that they have targeted for reflation, so real estate and stocks, well, that fiat money inflation gets burned out and they move down. So this is what's called buying low and selling high. Right now, dollars are overvalued, gold is undervalued. Convert those fiat monies into physical gold, and then later, when the opportunities present, you'll have the ability to convert that gold into income-producing assets when they are severely undervalued. Because here at ITM Trading, we have a strategy, and it's about making sure that you can sustain your current standard of living and build out your wealth base so that you can generate income for the rest of your life on the other side of this reset, and perhaps even leave a legacy to your heirs. So call your ITM Precious Metals consultant and see how physical gold and silver fits in and supports your goals and your strategies. And please, we do this so that you do not get caught looking the wrong way. And don't forget to visit the rest of the library where we hit on many, many topics. So now that's it for today. I hope you found value in today's presentation. And I hope that I made it clear why everybody needs to own physical gold and physical silver as well outside of the system. And you need to be as independent as possible so this impacts you as little as possible and presents those opportunities. So it's not just getting in, but it's also the exit strategy. Call your ITM Precious Metals consultant. They'll discuss the whole strategy with you and really what will work for you. So it's my pleasure. And again, you guys, on that oops email, thank you so much for your support during our evolution in the webinars. And I really hope that you're finding value in this. You take care now. Bye-bye.